Well, back in Australia, banks are said to be increasing the buffers they use to assess whether home buyers can afford to take out a mortgage. The move comes amid concerns by some commentators that some borrowers might not be able to meet repayments when Australia's record low interest rates do inevitably start to rise. Financial regulators, of course, as we've been reporting here, are starting to put pressure on the banks not to lower their lending standards while interest rates are down. For example, recently APRA's John Lake has said there are risks that can grow over time in a sustained low interest rate environment. Okay, let's speak with Tony Burke, Acting CEO of the Australian Bankers Asoociation. Tony Burke, thanks for joining us on the program today. How are the banks' lending standards and especially the buffers for or tests for borrowers changing?
Well, since the GFC, banks have been tightening lending standards in a number of ways. Banks have a primary duty to lend responsibly, and they do that. In recent times, then the regulators have commented that banks have been increasing their buffers. What that means is they're increasing if you like, the safety buffer to allow for the fact that interest rates may increase in the future.
And what's the size of that buffer or the criteria they're using?
Well, look, it's very much an individual determination. I don't have data on how that map across the board. So they look at an individual borrower's facts and circumstances and take a view not just on the current circumstances, but what might happen in the future.
Would it be fair to say that 2% has become fairly typical?
I couldn't confirm that figure. As I said, it's an individual determination for individual borrowers.
But you'd be aware of the kinds of buffers, in your liaisons with the banks. I mean, if we're being told there's extra buffers, can you give us a guide?
Well, I can tell you that they're being applied. I can't tell you in detail the size of the buffer for an individual customer.
You're assuring us that the criteria is tougher because you're saying the buffers are being increased. Why isn't there a bit more transparency on that? Because otherwise it potentially just looks like a PR exercise, given we know the broader discussion is that there's a momentum growing for more credit controls on the banks, which of course the banks themselves would not be happy about at all.
Well, I mean, the broader environment is that we have a low interest rate environment. Borrowers are being very conservative. Banks are applying appropriate prudential standards. As you noted, the regulators have been reminding the banks publicly that they need to maintain lending standards in a low interest rate environment, and that's just what they're doing.
Again, though, what's appropriate standards? Because the reports say 2% is being fairly typical. I've spoken to people who say, 2% is not enough. We have exceptionally low interest rates, unprecedented low interest rates in this country. And if we're only telling borrowers to prepare for, say, an extra 2% of interest rate rises over the life of a loan, and banks are only measuring against that, then that is not enough.
Again, I can't confirm the actual numbers. It's an individual determination made by individual banks for their customers, and that's not something the ABA is involved.
Okay, are the banks themselves worried about the risk that's building for a housing bubble? Is that why they're shifting standards, or what's been their motivation?
Look, I can't comment on the commentary around a housing bubble. There's nothing that's changed as far as banks' lending behaviour at the moment. Banks are lending responsibly, and borrowers are behaving more conservatively, as they are, for example, well ahead of their mortgage repayments, 20 months on average across the entire mortgage book.
My other question is around what we see as consumers, very fierce competition by the banks to grow market share. Westpac's offering a $1,500 cash bonus if people take out a mortgage with Westpac. NAB's paying $1,000, George $1,250 just for people to come over. I don't know, it just seems hard to believe that, we've got prudent lending standards and banks are increasing their buffers at the same time. They're obviously desperate to grab market share. Can those two things happen at the same time?
Well, there's an interesting balance to be found, isn't there? While banks must maintain lending standards in a low interest rate environment, banks are trying to maintain their financial performance, and they're trying to look after their customers. I'd say at the moment the balance has been found.
Okay, do you find that there's different rules? Are banks saying that they're using different rules for different markets? For example, when you look at low interest rates combined with, in the eastern states, 10 to 20% house price gains, for example, is there a feeling that there's a need to do different things for different markets? What have the banks been saying about that to you?
Look, that's possible. I mean, the banks haven't been speaking to us in detail because these are commercial decisions by the banks themselves. But again, the decision in relation to particular loan application is made on the basis of individual circumstances which will take into account a broad range of factors.
Final question: what are you doing as the ABA to? Is it your role to work with property valuers so that we can see that realistic property prices are being maintained? Particularly, as I said, for example, in the States where you're seeing 10 and 20% spikes in values, and where we're hearing, I guess, there's still fairly high LVRs in place.
No, we don't work with property valuers. Our role is on the policy side. We do, for example, work with the regulators on prudential standards.
So it would be the banks working with the property valuers themselves?
Possibly, but I
Okay.
couldn't comment on those discussions.
So what do you see as your priority at the moment in terms of representing those banks in policy?
To communicate what it is that's occurring in a factual manner.
Okay, but not without providing numbers though today, for example?
Well, because those numbers are based on individual bank
Yeah.
decisions for individual customers. I just don't have that data.
Okay, fantastic. Thank you very much.